¿Me escuchan? How's my sound? Last week I made a video and the sound was so bad and no one told me. Just let me know how it sounds. Okay, so you can hear me. And it sounds good, or does it sound crackly? What's the quality of the sound? Not just can you hear me? What is the quality of the sound? I should be more specific. Okay, you shouldn't hear other sounds. You should just hear me. And I shouldn't sound like I'm screaming. Pretty good? Okay. I'm gonna close one door. Okay. So in YouTube, I can clip off the start. We're starting a bit late, but this is where we left off, and I'm going to put my video on. Let's see. Oh, that's not even. I gotta go this way. This way. That's better. I even left just a little section for me on this video. Okay. So, all right. So I left you with this problem, and I left you with all the exercises on the platform. How did you do this week? How did you do last week? I want to share the platform with you. Let's see if I can do that. Looks like I'm looking into the screen. All right, that's not so great. Some light. All right. I don't know why this is not how it used to be. Oh, browser. Let's go for the browser. I'm gonna add. No. I don't want that. Oh, I have to figure it out. Okay, in the platform, in Moodle, I have the documents for Unit 1. I wanted to do more this weekend, but I didn't have enough time. I have a lot of courses, no excuse, but I didn't have a lot of time to give you in terms of working with the videos. I like to put timestamps into the videos so that then you can just watch the portion of these videos that interests you rather than watching the whole thing and scrolling through. But I did want to talk about a few things. Why can't I find it? Hold on. I don't know. So if you can go to Moodle, I want to add some more videos for you to watch that are just about some of the things you've mentioned to me that you want to know about options and some of the concepts you wanted to know something about the municipal bond debt of Puerto Rico and about the Act 60 we had talked about. So I want to put some information up there for you that we can later discuss. Okay, so you have all the Unit 1 documents and the chapters. And in terms of I guess I can do it. I can look on my iPad, right? No, that's okay. Not right now. So in terms of this class, 15% is assignments, and you have a test in 3 weeks. So that's not bad. We're still a good time, right? So you're going to spend the next 3 weeks. It's 3 weeks, right? The 14th of March. Yeah. You're going to spend the next 3 weeks working with Unit 1 and Unit 2 exercises, and I will probably start Unit 3. Well, we'll see. It depends on the kinds of questions you ask me to do. So what you should be doing is working on the reviews I posted and trying to solve them yourself. You notice I linked these videos into the platform. It's up to you if you want to go from the Moodle or you want to work from this playlist to watch videos. Okay, so I just put one document into Unit 2 so far. I need to put everything in there. Well, I guess we're going to talk about it today, so or if we get there. So I'm also going to put in, so I'll make a note here in the chat. That I will be putting review exercises into Moodle, not Moodle, into Connect. That's with the textbook, the digital textbook, and an assignment in there to review Unit 1 and 2 chapters, all right? And I'll make it due after the test so that in the process of studying for the test, you'll know more than before the test. So the test will be in the classroom on the 14th, and the classroom is the big classroom in Plaza Universitaria, okay? I feel like I'm too close to I did some adjustments with this computer. I think I moved it too close to me. Let's see if I move it back. Okay. So I wanted to show you a few things about YouTube. Let's see if I can do it here. So in YouTube, to watch these videos, and the reason I put them here is so you can translate them. Well, that's today's video. Let's go to see something else. I'm gonna turn the volume off. Okay, so here is a video, and if you don't know how to maneuver in YouTube, I'm just going to review that. List. Okay, so if you want to add subtitles, if I make this big, what happens? Okay, so can you see? Okay, so those items below, you can't see them if okay, so I'll just go smaller. I'll just do it like this. All right, so at the bottom of any YouTube video, you have some options here, and I've made these videos so that you can see the captions. All right, so as this video plays, it not translates, but it it puts up the words, all right? So you can actually turn that on while I'm dictating, or while I'm lecturing. You can actually see in real time. Well, it's not exactly matched with when I'm saying it, but it will put up the subtitle so you can follow that. Now, if you want to translate, you have to wait for the translation. It looks like the translation takes a day or so, if I'm correct. And the way to translate these. Oh, Andrea is asking a question, okay, about the assignment, and then I'll get back to this. The assignment will be after the test. So the test is on March 14th, and I'll probably put the assignment for after that, either the weekend or... Sabrina Longobardi. Sorry, my phone. So I'll put the assignment on for after the test or a week after. It's probably too much, but just soon after while it's fresh in your mind, all right? Okay, so then back to this. So if I want to translate these to Spanish, what I do is I hit this tool here and you can hit subtitles. Now you see what it says. Because of the way I've set it up, you can auto translate. So you press here and you can change it to Spanish. Now it's not a perfect translation, but it's better than nothing. Some of you, even though you don't feel confident with English, you might just want to watch the English subtitles. I haven't had time to go through and edit them to make them perfect, but they're pretty good, I think, in English. And because they're good in English, they translate well to Spanish. So that's how you do it, and it changes, okay? So did you know that? Did you know how to do that? So that's one main thing I wanted to show you. You can also change the speed. If you want to just scroll through really quickly, you change the speed. You can make it like faster, right? So you can make it like double time. If you just want to skim through things, that's really fast. Probably 1.5 is better for a playback speed. Okay, so it just rushes things. If you just want to review quickly what you saw. The other thing to show you is how to scroll through a video. Notice this video has, you see, there's like breaks here, you see. I've broken it up. What I've done in this video is I prepared timestamps. It's easy enough to do. I just put these in the comments. I wrote these in the comments, and then the description. I did it for my undergraduate course, but I intend to do it for yours as well. And that way you can just easily click to where you want to go. So I want to go to slide 59, and that will put me there on slide 59. Right, and I think I'll itemize each slide. All right, so that's how you maneuver. If you also, the other thing to tell you is to scroll through. If you're watching on your computer, oh, you can move this around. I'm on my iPad. It has different features, has different functionality in the iPad. So that's interesting. On your computer, you can actually use the arrow keys to scroll through. I didn't know you could do that on the iPad with moving the subtitles around. All right, any questions about manipulating or maneuvering through navigating YouTube? So that's why we're here, for those functionality. No comments? So keep in mind, if the screen goes blurry, make sure you refresh your screen. Okay. Okay, so let's look at this case. And did you have a chance to try it? How did you do? Who was able to solve this without trouble? You can brag a little bit. I'm going to shrink this just a bit so it fits. Okay, I have a good turnout. I'm very happy about that. All right, so no comments? No one tried this? Is that what you're telling me? So nobody got the right answer because nobody tried it. So let's try it. Oh, I'm still fidgeting with this screen. Okay, to solve this, this is the pension problem. It's two annuities. One annuity for deposits that is then matched at time period 30 that I mentioned to you would represent the accumulation of the fund, but it also represents the fund from which we're going to withdraw for 20 years. All right, so in this sense, from the first day, I mentioned that each position on the timeline is both the end of something and the beginning of something. I represent that here. It's the future value at time 30 of the accumulated deposits, and it's the value of the fund from which we'll withdraw for the pension. So $3,000 per year for 30 years. And now you guys are very young. Look at what it can grow to. Now, keep in mind, we're using 12% return, and 12% return I believe I mentioned, because 12% is the average return for investing in the stock market. So if this fund was invested in a way that follows or tracks the market returns, returns on the stock market, either you can actually invest in an indexed, in a fund or an index that mimics, top selling securities or top performing firms, right? So you can invest in that kind of a fund and earn this on average. Some years you're going to get negative returns, sometimes you're going to get positive returns and high returns, but on average, historically, over 50 or 80 years, if you look back, because you can find that it'll be, higher if you look at all those years than if you just look in the last decades. It's on average 12% return. So this is not, what I'm trying to say is this is not unrealistic. So right now you have $3,000 in this problem at 12% on average, or this is per year. That's how this fund is set up. At the end of 30 years, receive 20 annual payments starting 1 year thereafter. So let's see what we do. So first, I'm going to compute the present value because that's the formula I taught you. And my approach is to limit the number of formulas I give you so that you don't think that there's a lot of formulas out there, right? All these formulas draw from two, the perpetuity formula and the basic time value of money formula. Remember, this annuity is just the perpetuity formula with an adjustment factor because it's fixed number of payments, right? So let's put this in the calculator, get this amount, and then we'll talk about what we have to do. So it's going from left to right on our calculator. Let's clear TVM. Should we do this together? So it's 30 years, 12%. The payments are 3,000 and they're payments, so they're negatives that go into this fund, and I can put 0 in FV for now and compute the present value. So that's the present value That's what it's worth from today's perspective. If I was to do that, it's worth $24,000 today. But that's equivalent to what in the future? So I need to accumulate that to future value. So how do I do that? What I'm going to do is show you, I didn't show you this before, maybe this is logical for you. I'm going to overwrite the present value, and I'm going to instead ask the calculator to compute the future value. You see, it's very simple in the calculator to get one or the other. All it's doing is the basic time value of money accumulating 24,000 and some dollars for 12% for 30 years. So that's the amount on your page. It's $750,000. I didn't do this exercise earlier, did I? I left it for you, I believe. So that's what this is. So on a test, you would write this amount and then this accumulated amount to get the future value. So I'm taking the formula I know, this formula of annuities, together with the basic time value of money to get this amount here. So let me know when you've found that. Try it yourself. Mm. I'm waiting for some feedback. The idea of the class being interactive is the reason why we're here doing this together. So let me know if you get that. Thank you, Alejandro. Anybody else? I'll wait just a few more. Let me know you got it. And just the first part, not the final product, but I mean the final amount. So all I want you to get is this. Somebody else. So the steps are, I'll put them down here. It's going to be 30 into N, 12 into I, PV blank. Well, we started with PV blank, but you can just skip that part because I was trying to show you something. You could just leave that as 0. That's what we did at the end. And then, good, Julio. Adamaris, great. All right, and then the payments are negative 3,000. And then you compute future value and you get this. Great. So that's the fund. Great. Good. Now what should we do? We're going to put that into our, we want to repeat this now. We want to do another calculation, but with this number. So what you can do, since it's in the FV key, I think you should store it. And we're going to review the storage keys after this. So you can store in one. So press stow and 1. Those are 2 different keys. And that'll store that amount for you. And what you want to do next either clear TVM or again from left to right, enter these values or these values for this formula. And that will be, and will be 20 now. Again, 12% for the interest. And now you want to PV, you're going to put recall 1. That will recall the number that you had in storage. And that is your, the amount you're going to put in PV. You can make it a negative so that then you're withdrawing positives, right? Because you've put this into a fund that now you're going to draw from. So you can change it to a negative because that's the value, you didn't take it, you didn't take it away. You didn't walk away with this. You reinvested it. So this is out of pocket. This will be a negative and put that into PV. I think I might have different instructions on the next page, but that's the best way to do that to keep the signs straight. And the payment is what you want to find. So we're going to first, before we do that, we're going to, we want to find payment, but let's put 0 into FV because that's not what we're interested in. So now you can compute payment. So compute payment, and what do you get? So I'm not going to turn the page. You guys tell me what you get. Remember to reload the screen if it's blurry. I'm going to reload mine. I got a faster internet connection and I got a new cable. So hopefully there'll be no interruptions and the speed is fine and no buffering will happen. I also have a hotspot. So I think I have every contingency plan covered. If the power goes out, that's another thing. But I can reboot on my running through the hotspot. So give me a number. So if you save $3,000 a year and you can earn 12%, reinvesting the whole amount at year 30, what can you withdraw every year? Keep this in mind. For future personal investments, for retirement, no one's got a number yet? Looks good. Sandra got it. Okay, let's see. If anyone can sincerely show me their answer. Don't just copy Sandra's, in other words. Let me know what you get. I mean, Sandra could be off on her decimals. Somebody else send me a number, but it looks close to what it looks like the right answer. Very good. So I got 2 the same answer. Gives me hope. You got it right. Let's see. Funny enough, last page. Where's the last page? One moment. Keep letting me know if you got it. All right. This is what I did. Okay. So this is exactly what I said to do. Good. Okay, you guys got it. Good job. All right. So that's it for this set of notes. I want to backtrack and look at setting up the calculator completely, because I skipped over that to familiarize you with actually using the calculator. Now let's go back when it's more meaningful to you and look at the settings and how we store values. Before I do that, I want to say this is not a bad deal, right? $3,000 a year for 30 years at 12%, and that's the catch. It's a very high interest rate. You have to get that, maybe taking greater risk than some investing in government bonds, or putting your money in a savings account, or in a GIC, guaranteed investment. So, but this is the reward. It's $100,000 a year, which is not so bad. And then doing something like indexing for inflation, investing in a supplemental account that we mentioned before, could provide the income you need when you're on fixed income or when you're retired. All right, so adding to that your Social Security, if it's, I shouldn't say this, but if it exists by the time you retire, and any other kind of passive income that you make. Maybe you rent a property, or you have an annuity where you've put an inheritance and you're drawing money from there. All right, so this gives you an idea what can you do now for the future. So let's go back, unless anybody has questions about entering this. Let me check the chat. No, you guys are quiet. All right, so let's go back. I'm going back to the beginning. Well, I'm going to go back to that other document, my documents. So what I did was, with the documents, I prepared the markup. I think I put it on yours. Let me make sure. I'm like teaching 4 classes. I got to keep them separate in my mind. Let's see if I did it on yours, and I put up the markup notes. Let's confirm. If I didn't do it, I'm going to do it. Okay, I did, right? So lecture notes markup. And so I did that before this class, so you're going to have to add if this is going to help you. But I think all the notes are there. I explain these steps on the next page anyways. So what I want to do is go back here to the very beginning and discuss the setup. So this page is very important. You might find yourself coming back here to remember how to set up your calculator if something happens and you have to buy a new calculator, or somehow you have to reset the whole calculator. You need to reset these keys. I also want to take the opportunity to explain how to use the storage keys, which I'll talk about here. So to review, or to introduce, because I don't know that I even discussed it much. If there's a reason for you to reset the entire calculator, you're not getting the answers that are in the notes or that other students are getting when you're solving problems, then you might want to reset the whole entire calculator. And in the 20 years I've been teaching this class, there have been defaulting calculators. So the students have had to return the calculators, but it's only been twice in those many years. So it's very rare, right? But it can happen. So before you do anything like trying to return a calculator, you want to reset the whole thing and see if that helps. And this is how you do it. You clear, to clear all, like remember, we have many worksheets. We have the TVM worksheet, we have the cash flow worksheets. I'm going to teach you, if you haven't learned already, how to use the statistic worksheet. So there's lots of data storage spots. In addition, there's the memory keys that we're going to talk about. And those are what you might want to clear all at once because you don't know why. Because there's some defaults that are in the calculator, but you might want to reset those. And I showed you about this one to set that you're going to interpret your compounding frequency as the same as the number of periods that you're compounding. So by saying once per period or changing period per year of compounding or frequency to 1, then it's actually compounding per period. I think that's a better way to explain it, but it looks like periods per year. Setting it to 1 is what you want. Okay, in some calculators, the default used to be 12. So it's like a monthly compounding over the year. So, but we want to use our calculations, or sorry, our formulas in a certain way. We want this to be 1. Okay. So you might want to reset the whole calculator. That's how you do it. Second, reset, enter. That we can do it now together, and then we'll reset the whole calculator. So second, reset, enter. Second, reset, enter. Now it wipes out my memory, clears it all to default. So my decimals are only 2 now. I have to reset that. And let's see the P by Y, what's in there. Okay, so it is, the default is 1, so that's good. But in the past, it was like a different number. So that's a good thing. All right, so now the calculator is completely reset. Let's see what else we have to do to it. This function clears TVM. We learned this, right? So we did use this. Second, clear TVM. And when you wanted to clear just that TVM row, this one here, and TVM, clear TVM is above the FB, and it's activated with the second function key. What next? There are a variety of workbooks, like I mentioned, the cash flow workbook, the statistics or data workbook. You might want to just clear those and not clear your memory keys, not clear the settings for P by Y or any other frequency settings you have, and you don't want to clear the cash flow keys. So if you just want to clear one worksheet, then you use this clear work. And the way you use it, you must be okay, so you have to be in the worksheet to be able to clear it. So the example is, let's put some things into clear TVM, into TVM. So if I do this, I just put some values in there. And then let's say I just hit the clear the screen and I say clear work. It's not referencing any certain worksheet, and all the items will still be there. Oops, I'm not going to be able to show that. But if I do compute FE, oh, it seems to be a, no. Should not have cleared it unless I was in the worksheet. So let's do a different one. Let's do, if I use the CF keys, I'm just putting numbers in here. Okay, so there's stuff in the CF keys, right? And I'm scrolling through the CF cash flow keys to calculate the NPV, or what you're going to learn about the IRR later. That's where you put the data or the cash flows. So if I want to clear the CF workbook and I hit second clear work, it's not going to work because the numbers are still there. I was not in the worksheet when I asked to clear the worksheet. So it's not going to know to do it. It's not going to know what to clear. So I have to clear the workbook now once I'm in it. Okay, so that's the catch. You need to remember that. And let's see what else. So, all right, let's get our decimals back. I want to put 9 decimals on my, that's the most you can have on the screen of the calculator. So to do that, you hit second, format, 9, enter. So let's do that together. I want 9 decimal places. So second, format is here. Now it's 2 is the default, so you need to change it to 9 and then set it by hitting enter. So that's going to work now. So let's test it. Let's take 11 divided by 5 and see if we get 9 decimal places. Divided by 5 divided by 8. So there's 3 decimal places. I want my 9 decimal places. 4 divided by 9. 1, 2, 3, 4, 5, 6, 7, 8, 9. So that's the most you can get. Let me see if I can get more. Let's try that. So it was second, format. If I put 10, enter. No, it doesn't work. So 9 is the highest I can go. Second, format. No, so 9 is the highest. I guess the screen reserves the other space to put other things. Exponential or scientific notation. I don't know. There's other things it wants to put in this other square. If you can see, it's a little discolored. So DEC has to fit there. Right? So when I go second, format, it takes up that shaded space. I can't have decimals there. Right. But in fact, the calculator does store several more decimals than it displays on the screen. So I'm not sure how many, but when I was first informed about this calculator, it was like 25 decimal places are stored. And that becomes important. You'll see when you're working with interest rates and the banks are working with, more than just 2 or 5 or 9 decimal places, right? You want to operate, you want to be able to make calculations like they do. Computers can store hundreds of decimal places. Calculators, some fraction of that. But yeah, at the time where I heard about how many it stores, it's like 25 in memory. All right, but displays only 9. All right, so what's left? All right, so we already took care of this. Compounding once per period, you want that to be 1, which is the default, so that's fine. And we learned about begin mode. To set your calculator to begin mode, it's second begin, second set. And then to put it back to end mode, you just repeat it. Second begin, second set. And all right, so let's talk about the exercises. Let's see which ones you want to work on. Let me open up the course page. Let's see if I can do that. Mm. All right, so have you looked at any of the documents yet? Where should we start? If you haven't looked at any, I start at the beginning, but I prefer, well, I hope you looked at the documents. Let me know. Where should I start? So I've included chapters 1, 4, 8, and 9 because 1 is the background to corporations. Chapter 4 is basic time value of money, discussing time value of money and the formulas, introducing them. And 8 and 9 are about stocks and bonds. And I think it's important that you understand the context and some of the stories that I tell. You know, like our assumptions that we make basically when we're using these formulas. They come from understanding issuing stocks and bonds. So no comments. Where should I start? Okay, think about it. I'll be back. Has anybody reviewed all of these already? Has anybody completed their review of these problems? So this is what you should have been doing during the week. I think it was enough time to review them all, but we can do it together. Because I really want to get into the next unit. The TA before, let's see. And maybe I put the wrong, I might have put the wrong thing up there. Oh, I did. Yeah, that's funny. I'll put up the proper one after class. I have it. Well, you know, when you see things aren't right, you guys can email me. You don't have to wait for the class. So this is the first time I teach this class, so I have to modify all of my documents. It's going to take time to upload them, but I have them all. Just making a note. Oh, okay. So yeah, there's two formula sets. All right. So that's a good question. This one. So this one, the difference between this one and the other one is that I am starting at 0 in this one. You see all my formulas start at time now, but the principle, what we're doing, could occur at any point in time. I just have to be wary of the rules that my valuation using these formulas is always one period before the first cash flow, right? These formulas with annuities and perpetuity depend on the first cash flow. So keeping in mind this formula only goes with this timeline beside it. It has to appear one period before. So I also made this set of formula where it starts at T, and you can call T today or T tomorrow, T for another day, you know, in the future. And it doesn't have to be right now, but it's same pattern. So yes, you're right. It looks pretty much the same. It's just I've changed 0 to T, small t. And it's that way in all the formula. But still, the formulas are the same. I've just emphasized in the perpetuity here, it says T plus 1. So again, reminding you that the first cash flow has to be one period from small t when I want to value the future cash flows. So that's a good question. Okay, so these problems are all for review. Then in unit 2, we're going to repeat the same type of problems, but we're going to introduce the idea of interest rate conversion. So let me, so you notice it's the same chapters for unit 2. It's still time value of money, but I want to solve problems with interest rate conversions. And that's when we have the setting or situation where we are compounding more than once a year, all right, or once a period. And how do we adjust our formulas to deal with that? And the principle is, we discussed it last week, is that you have to match the timing of the payments. That will determine that's your tether. That's what you're going to follow, right? Whatever the timing of the payments is, that's the interest rate you need, the compounding frequency of an interest rate with that timing or that frequency. So I have to teach you how to do that, how to convert interest rates. So that's a whole project. Okay, so let's solve a few of these. Give me a minute. Get up the screen. And I have to put my video back on. So give me a second here. Oh, before I do that, I do want to talk about the memory keys. Let's do the memory keys first, and then we'll get into those exercises. Okay, so all right, so the memory keys are here. So you saw me use store 1. In fact, there are 10 storage slots for values from 0 to 9. We used store 1, but in fact we could have used another number. So let's say we want to store the number 11. So to store 11, you write 11, or you enter 11. Actually, I'm not going to put anything around that. So 11, and then you hit store and 1. So that's in storage slot 1. But let's put another number. Let's put 9 in storage slot 2. Now, obviously, that's not necessary, right? Why would I store these? I'm simplifying. What in fact you're going to store in there are numbers with a lot of decimal places that you don't want to lose or retype, because if you retype them, you might make an error, right? You might do it erroneously. So what I want to do is store 11 in storage 1, and 9 in storage 2. And then what I want to do is take 9 divided by 11. So the way to do that, I mean, I could just divide 9 by 11 and then hit equals. Let's do this with the stored values. And the way I call up the stored values is I say RCL, or recall. I used it just earlier. That's for recall. So I'm going to recall 2 and divide by recall 1, and then say equals. Now it's not realistic to do it this way. I'm just trying to show you how to use the keys when you have long numbers that are hard to work with, long decimals. So let's put 11 in store 1. Let's check first what's in storage. Let's see. If I hit second mem, you see what happens? My memory keys. So workbook of memories. So this is memory 0, this is memory 1, memory 2, memory 3, memory 4, using the arrows to scroll through. Those are my memory keys. So let's clear the screen. So I want to put 11 store 1, and I want to put 2 in, not 2, 9 in store 2. Now let's see if they're in there. Let's hit second mem. So nothing in 0, but so memory 1 is 11 and memory 2 is 9. And then these ones are untouched. Okay, so everything's in there. And they're going to be in there until I either do a hard reset or I hit second mem and I reset with a second clear work. That'll clear it. Otherwise it won't clear. If I just do second clear work, it's not going to clear that unless I do a hard reset. So it's still there, you see? So using a financial calculator, it avoids, it prevents you from making erroneous deletions, right? It stores things, it's pretty safe until you decide to clear it. So let's take, what did I say I wanted to do? I want to divide 9 by 11, but using recall. So recall 2 divided by recall 1. So recall 2 divided by recall 1, you see? And that's my answer. Any questions about it? All right. All right. All right. So now we have a lot of resources from the calculator. We have the formulas in tow. So let's try and solve some problems. So I'm going to bring up, which one do you want to do? Review, the first review? First review. Okay. Let me turn this off for a second because I am so I'm going into my archives. All right, so this is it. I don't know why it looks hazy. It's weird. All right, can you see that? What I'll do is I'll take it. So let's look at let's do one at a time. Dailin asked to go from the beginning, so let's try. Let me know if I did this already. All right, so let me give you a couple of minutes to try that and give me the answer. So what you should be doing is writing the formula out and solving with your calculator. So I'll do it all, give you a minute to get the answer. Remember, you have all the claves for these. So what you're going to do is set it up. And you don't have to write it down, but I will. So at time 10 years from now, an amount deposited now will grow. And notice this subscript and this one equal this one here for face value or future value. So the relationship between these values is that the amount of 1 million is equal to the 150,000 times 1 plus I to the power 10. So you have to write that down. So I want to see this, and then I just want to see the answer. You do not have to solve, unless I say show all your work, all you have to do is give me the answer. You don't have to solve algebraically. but you should be able to. Okay, even if I don't ask you, you should be able to solve algebraically. So what I'm going to do is put, so clear TVM for 10 years. The interest rate is what I want. It's 150,000 deposited. And there's no payments in this problem, but the future value, well, it's deposited. Let's go back and do that to put a negative in front of it to keep track, right, of cash flows. No payment, and then compute, no, we have to enter the face value, future value is 1 million. 1 2 3 1 2 3 is $1 million that we'll get. Compute and ask for interest. Any questions about that? Do it yourself. Very good, Luis. Okay, good. Okay. All right, so you can check alongside at the clave that it's correct. Okay, so that's it. So in terms of what you write, you just put the number down here like that. You should follow the instructions above. If there are more than one decimal place or 2 decimal places, what do I say here? So final dollar answers should be 2 decimal places because you want dollars and cents, and that's how we operate, right, with dollars and cents. Final interest rate answer should be rounded to 4 decimal places if expressed as a decimal, or 2 if expressed as a percent. So follow the instructions here. I also mentioned show all your work for part marks, including timelines. So I didn't show any, I didn't show the steps of deriving I, but in this problem, I mean, you don't need a timeline. It's unlikely that you're going to mess up the problem, but if you have a concern with a more complicated problem that you know what, you might lose points if you don't show the logic, right, that you've used. I can give you part marks if I see a timeline, if I see some reasoning or logic. If you have time, you could even solve algebraically if you're asked to show your work. I would reserve that for the more complicated problems, but you could do it here if it didn't take up too much time. But time is going to be what you have to manage during this test as well, right? So it wouldn't be worth investing that time. But if you had extra time on the test, you could do this with your, with your calculator, solving. So this will cancel, so I'm going to solve it step by step here. That's 4 zeros, and that's 4 zeros. And this simplifies to 100 over 15. Oh, I'll just take off the dollar signs because they'll cancel, right? You have a dollar sign on top, cancels with the dollar sign below. And I take the 10th root minus 1 equals I. Do you know how to put that into the calculator? How do you put a 10th root into the calculator? You might need this for later, so I'll do it now. So you would take 100 divided by 15, and this needs to be to the power 1 over 10 minus 1. So to put that in your calculator, the finance calculator that we have, I would do it like this. I would say 100 divide by 15 equals, and then you say to raise to the power of 10, but you don't want it to be 10. You want to actually invert 10, so you use that key. Then you say equals, and then minus 1 equals. Try that. And then finally, you have to minus 1. No, we did minus 1. Minus 1 equals. Yeah, to get the answer. I get the same. So you can confirm your answer. In a way, without having the clave, if you approach a problem from 2 different angles and you get the same answer, you can feel more confident you got the right answer, right? So I'll teach you to do both. If you don't have time and you're rushing, solve everything with the financial calculator first and then go back and check with a different method. If you're insecure about the calculator, you might want to plug in the financial keys a few times. So let me add here what I did to put this in the calculator. From left to right, I entered 10, and then I is what I want. And I told it that it was 150,000 present value, which was invested, nothing in payment. But then I can, and then I'm going to enter 1 million to be received in 10 years and compute the interest rate. All right, so we've done this, spent a lot of time on a very simple problem, but you don't want to get this one wrong on a test, right? So this is the one you want to get right. Let's do the next one. Let's get the next one. If you need to see that again, let me know. All right, so try this one. Draw a picture. Let's see if we have the same depiction. Right. Mixed cash flows using the NPV function. Very good, Sandra. So let's draw this and let's interpret it. So this is really important that you make a drawing. In case you interpret it incorrectly, I can still give you some marks. Otherwise, I have nothing to grade you with. So there are, starting 1 year from now sounds good. So one period from now, $2,000 to be received for each of the next 3 years. So 1, 2, 3, $2,000, $2,000, and then 3,000 for 2 additional years. This is what I'm looking at. Now, solving this just with the NPV formula or the mixed cash flows approach, it's fine. It's fine. I didn't restrict you from using any particular formula. I just asked for the NPV. So it's ironic, usually net present value. Net means you're investing something now to get something later. But I haven't mentioned that. All I've said is what's the value of receiving these and calling it NPV. So hopefully that doesn't confuse you, but that's how we use it. Even if there's no initial outflow, we can still use the formula. All right, so you could put a place mark for time 0, but usually, I'll put it in. I'll put it in because if we want to use the NPV formula, there has to be something there, right? If we want to use that function on our calculator, there needs to be a number there. So notice we're not doing this as though it's a mixed cash flow where I'm trying to figure out the value of them. I just want the NPV. What's it worth to get this string of cash flows later? Which is essentially the same thing, but anyway. So you need to write this. I need to see this to get any part marks. You need to do that right. And then you can just put these into your calculator. I'm not going to spell out how to enter it. You go back to the calculator, back to the notes that describe how to enter the the values into your keys, your cash flow keys. But I'll do this with the calculator and show you, and you can take note if you've made a mistake. So I want to use my CF keys, and let's make sure it's clear. Okay, it's clear. If I'm not sure, I just hit second clear work to wipe it out. Now there's nothing in CF0, there's no initial investment. So I just put 0, enter, and scroll down to the first amount. Then I'm going to get 2000, and I'll get one of those, but I could use the frequency key because I do get 3 of them, right? I get 3 of them, and then I get 2 periods of 3000. So 3000 for 2 periods. Oops, what happened? Let's see. I have 2000 for 3 periods and 3000 for 2 periods. I'm not sure, I might have hit something by accident. Then I ask for NPV, and I need to put the interest rate in. So it's going to be 5, enter down, and compute the NPV. Luis and I get the same answer. Any questions? Do you want to see it again, or will you watch the video to see that again? Yes, it can be any of those. Yeah. Positive, negative is 0. Can go into the initial cash flow, CF0. Okay, ready for the third one? That was the initial one that was requested by Luis. Oh, my screen's gone black. How's the sound? Is it clear? Is it distant, or is it close? I should try to listen, but I'm counting on you. All right, let's go. Next one. Oh, I keep leaving, and I just want to go back here and get the next problem. Okay, so number 3. Starting today, we will receive $2,000 for renting out our apartment for the next year. We will raise the rent to $3,000 per year for an additional 3 years. What is the present value of these mixed cash flows with 8%? So the difference is today we get $2,000 for renting out our apartment. So we get an advance, right? So this is an advance, and that's for the next year. We will raise the rent to $3,000 per year for the next 3 years. So what do we do now? So you can use mixed cash flows again. I don't know why I'm putting arrows here. Let me get rid of that. No, arrows are not necessary. So practice making these timelines. So I don't actually think you can increase your rent so much. There are some restraints on how much you can increase your rent. But anyway, this is the example. Right? So this is just emphasizing that it's $2,000 up front plus, and then you use the time value of money basic formula to make this like NPV. So I'm calling it NPV, but it loses the concept because there's no negative here, but I can still use that formula. All right, I can still use that, the functions, the cash flow functions in my calculator. Just keep in mind that this is positive, not a negative. So, which is more realistic, right? You get paid upfront to rent your property. So let's go to CF, let's clear it out and begin 2,000 in the initial cash flow, and then 3,000, scroll down, and I want 3 of those, enter, and I'm finished. That's it. So then I say NPV, and I have to enter the 8 and compute. And that should be the answer. How's that? Ready? The next one, you just keep going. Are you guys appreciating this? Am I going too slow, too fast? I say take advantage of this opportunity to work with me so I get some feedback about what you need me to do. I can customize more. Exactly, Louise. Something was there. Yeah, good. All right, mortgages. All right, so what's a mortgage? Mortgage is you borrowing money. So it's a loan to you or a couple in this case. And they're borrowing at, okay, 1% per month because mortgages are paid monthly. So let's take note of this. All valuation problems begin with the first step. Identify the timing of payments. Now, I didn't do this before because there was no conflict in the frequency of compounding and the timing of payments. So let's verify that that's the case here as well. Identify the timing of payments and convert all variables to the same compounding frequency. So when are the payments? Payments are monthly. Wait, sorry, go back. Payments are monthly and the interest rate is monthly. So we're good, but I just had to put that in there. As long as they match, we're good. The only other variable we have to modify is which one? Or the only variable we have to modify is which one? Right, but we need to, right? We have to, yes, we have to convert into the same frequency. I'm going to say to the same frequency, not compounding frequency. It makes more sense. So we need how many months? So it's 20 years times 12 months per year. Oh, well, I'll keep all in red what I'm doing in my conversions. So we get 240 months. So now we have everything in months. Very good. All right, so let's solve the problem. It's a $100,000 mortgage, so I have to write the formula out. $100,000 mortgage is what I receive, and I want to find the monthly payment. I don't know what it is, but it's going to be, okay, we assume the mortgage is paid at the end of the month. It doesn't say here, okay? We're going to assume, because it doesn't say, that's a fair assumption. In fact, probably have to pay at the beginning of each month, but we're going to assume it's the end so we can use our formula. And that's just fine because I didn't clarify that's a fair assumption. So then 1%, this is the formula you're going to write. So this is what you have to write down, and then the solution. So to get the solution, we're going to use our calculator. And I mentioned to you, don't write down the keys that you punch in your calculator for points, but you might want to write it on the page, right, of your test. But that's not for points, right? It's just for you. So N is 240. And then I by Y is what I want. The PV is going to be what I get. So it's 100,000 that goes into PV. Payment, oh no, I know I, what am I saying? Sorry. I is 1%. Sorry about that. What I want is the payment. And do I need FE? No, I'm not going to work with FE. I'm going to work with PV. So then I compute payment, and what do I get? So I wrote there, always assume end of period payments unless you're told otherwise. Okay, any answers for me? That looks good. So 240, interest was 1, PV was 100,000. Payment's what I want, but I have to override future value. And I compute the payment. Very good. And it's a negative because that's what I have to pay, right? Or that's what the couple has to pay. The couple has to pay 101. And then 9 cents. 9 cents, Luis is right. Yeah, so you have to round up. The bank will round up. So we round up. Yeah, I think it's 101. 101.09. Let's go back and see that. Let me write that again. And this is all I want to see on your test. Great, great. More people are responding, so it's more interesting when you try yourself. Should we take a 5-minute break? Okay, let me give you a problem, and we'll take a 5-minute break. So the problem I'm going to give you is the next one. So something different. So 5 and 6. So let's give you 5 and 6 and take 5 minutes. So we'll start again at I'm just starting in at 8. Let's just start again. Let's take 10 minutes. It's very strange that my iPad time is different than my computer time. I don't know why. What is going on there? Sorry, getting confused. All right. Take your break. You can write questions in the chat if you have any. Okay, I'm back. You hear me? All right, so let's see where we're at. So how'd you do? Did you get any answers? Again, you have the clave, but try and avoid that. ABC Corporation is expected to pay quarterly dividends of $1 per share beginning next quarter and continuing indefinitely or forever. Given the risk inherent in ABC shares, the required expected rate of return for investors is this amount per quarter. What is the fair price today for a share of ABC Corporation? So what we're doing is we're going to use a valuation technique of valuing the present value of future cash flows. Dividends are the returns to investors each period, in this case quarter. So we need to adopt our rule here. Right? Once again, identify the timing of payments and ensure all that the cash flows match. The timing of cash flows match the frequency of the other variables, right? So we have here that the timing or the dividends will be paid each quarter. So we need the quarterly rate. What did we get? Per quarter. So that's good. So those are per quarter. And then we don't need to know how many periods because this is going to be solved with the perpetuity formula. There is no end to payments. So using that formula, the price, one period from now, would be the $1 over this rate. And that's it. It's very simple. As complex as it is, we simplify, right, to this. That's the perpetuity formula. And what did you get? 41, 47? So let's see. So I'm going to take 0.024114. I have to see that again. 0.024. 0.024114. And I want to invert it. I want to put it on the bottom and multiply by 1. So it's 4147. Louise is right. Right. Do I use the inverse button? Remembering perpetuities are not programmed into the calculator. You have to actually enter the values from the formula. Okay, let's go to the next one. While people are reading that, let's read the next one. Okay, so go back through your notes and see, how do you deal with this situation? My ears. I pulled it apart during the break. What did I do? Give myself a head massage. Okay, so I'll draw this one. So I'm drawing the periods here, and the periods will be quarters. So I'll just make a note that these are in quarters. So it's going to be $1 per share. I think it's like this. Oh, now I'm questioning myself. I need to check the climate if it's going to grow in the second or the third year. So this is why you have to draw it, because there may be debate that it was clear. In this case, right, okay, so it is intended that it takes place in the second quarter. It's just like the formula. So that the initial cash flow is one period from now, and then the growth kicks in. And we know the formula for this. The formula for this is that the price times 0 is the $1 divided by I minus G. So I is the, from the question above, is this number. And then minus G, which is 1. And this amount is in the denominator. What do you get? What do you get? So this is a growing perpetuity formula. So I try and keep things as simple as possible, making things look like the formulas on the formula sheet. Not inventing too much new materials or new formulas or new variables. So when I calculate this, it's going to be $1 over 0.014114. And you can use the same tactic that you did before, just invert this number. And what do you get? Okay, so that's the debate at Amaris, the way it was worded. So it says, investors anticipate in 2 quarters, dividends will experience growth. So in the second quarter, so in 2 quarters, it looks like it should be here the way it says it, but I think, within 2 quarters, in 2 quarters. So that's why I draw it. And if it's not clear, I can either give you all the marks or part marks. So from now, in 2 quarters would be here so that they experience the growth here, right, to the end of the period. So what do you get if you do it this way? So this is like the simplest set of problems. Obviously, it gets more complex, and I appreciate Adamaris being ready for complexity. Because I certainly do challenge you. Okay, so the other sets of questions I'm going to leave because I want to talk about interest rate conversions before we go, and we have some time. Just give me the answer for this and I'll move on. We finished the first review. $70.85. Yeah, that's what I get. Okay, so I would make a timeline for that in case there's a dispute between interpretation. You can show me what you were thinking and you can argue your point. Get some part marks. Okay, so I'm done. This is good. So this is done. We're going to move now to interest rate conversions. So here, the next unit, I don't have too much posted, but I will post after class. Oh no, I don't want to go. So you have these, I'm going to fix the lecture notes for the other calculators. And you should work through the other solutions. Notice in the annuities review here, I asked you to solve these problems using annuities, okay? You're going to see in the solutions that it looks more complex than just making a NPV or mixed cash flows formula. So I want you to try and use annuities because it's a skill I want you to develop for the purpose of the more complex problems. And, uh-oh, I lost my page. Okay, so work on those. The solutions are all there, okay? And so you can expect questions similar to these in the test, but I'm going to put interest rate conversion, so you need to learn about that. So what we're going to do is start with a statement. This is my credit card statement. And this is old, but it could be just as well today. Your credit card, if you look at it, you should be getting a statement. In your statement, it should include a breakdown of your rate. So my question is, when you look at this and you read this, I want you to tell me how much you pay, how much would I be paying, what is my interest rate? When you look at this, you have 2 percentages there. Are they the same number? How are they related? And what interest rate am I paying? No takers? So I paid no interest, so that doesn't help you, right? I paid nothing because I usually have my credit cards at zero balance to avoid any extra charges or any interest. I use my credit card as free money to take advantage of things before my paycheck. And I never pay interest. Well, almost never. Now, this is not a personal finance course, but you can use things that we learn to intuit or to have a better sense of things. Okay, what was the question? The question was, what interest rate do I pay? There are two numbers here. Are they related? And can you tell me what interest rate I pay? What's my interest rate? So for each dollar that remains in the balance by the time the period is over, right? The waiting period between compounding, what interest rate do I pay? It's usually credit cards, you have 20 or 24 days or 25 days of grace. So you can buy something and you don't get charged interest for a while. But when the interest starts, what do I get charged on this credit card? Okay, so we have one suggestion here. Julito suggests it's an annual interest rate that I pay. What does anybody else think? Do you agree with Julito? Do you think it's a different rate that I pay? All right. I want you guys to catch up in thinking. So this is more meaningful for you, because me to throw down a bunch of formula right now is not going to be helpful. I want you to think about it. How is interest charged on a credit card? Is it charged? Do you get charged interest every year? What's the compounding frequency of the interest rate? Compounding frequency on the balance. Nobody else? So Julito's kind of okay in a way. He's not being precise. Like basically I can figure out the rate and then I can convert it to an annual rate to understand it in annual terms. But when it comes to credit cards, credit card balances are charged interest every day. Okay, so it's a daily rate. So it's a daily rate that we get charged. I'm going to go back to my iPad. 1 minute. To my work. Just opening up a few sheets in my iPad. All right. Uh-oh, I lost the screen. Let's see if you can see my screen. Sometimes we lose connectivity. Okay, it's up. Okay, so what I have here is this is the rate that I'm charged every day. So this is the daily interest rate on balances, right? So if I don't pay off the balance, then I get that charged from the beginning of the time period. I get charged every day that amount. So for $1 invested, not invested, sorry, in the balance, it's not exactly an investment, then each day so there's going to be 2 zeros in front and then 0. So it's a small number. I get charged that much, right? So it's not even a cent that I'm going to be charged, but there's 30 days in a month and there's 365 in a year, and this can really explode. So what I want you to tell me is how much, if I left the balance there for every dollar, how much would I be charged in a year? How would you figure that out? For each dollar. So I need to use 365 days. We just round it to 365, okay? Even though there are leap years, and I get it. Let's just speak about the non-leap years. Keep it simple. And don't worry about the other number. We're going to talk about that other number in a moment. I just want you to tell me how much interest would be charged. What would be the balance after a year, and how much interest would be charged? Not times, Luis. You're close. Not times. So this is the point I'm trying to drill in or drill home, is that it's exponential, right? It's exponential. I have to say, remember the formula. So basically you're putting 365 there. Yep. So 1.000500411 and 365. Power compounding. Now, if I said simple interest, well, you still would have it wrong, but because you'd have to take the rate times 365. But okay, do the compounding and tell me what you get. Aha. All right, so Sandra got 1.201960. And that's with all the decimal places that you can get. So there's some more decimal places there, but we'll just drop it off. We'll 3 dots just to say we rounded, okay? Or we're not rounding, I'm just gonna leave them off. It is pretty much rounded. All right, so I need those numbers though, because when we do this, you have to be very precise, okay? But I'm just, for illustration purposes, I just put 3 dots. Okay, so how much interest then? So So $1 is the principal. So 20 cents per dollar each year for every dollar. I'm trying to write it. So if you just had a dollar, if you had a balance, for each dollar that you didn't pay back, it would be 20 cents per dollar. Now you have to remember, you're earning interest on the dollar and then interest on the interest, right? This is what it's going to be. So now that you know that, let's go back. I'm going to put some names on these things because you're going to practice making this conversion. What you've done is you've taken the daily effective rate. That's what that is. That's what me and others actually pay. So the daily effective rate, I'm going to put it in words. This is called the daily effective interest rate. And I'm going to give it a symbol for its name. I'm going to give it the symbol EPR for effective period rate. And I'm going to say it's daily. So it's 1 over 365. All my subscripts here will be in fractions of a year that it's related to, right? It's a fraction of a year, 1 over 365. So in words, you could say effective period rate, the daily effective period rate. So this represents day. And what you've done is you've taken the daily effective rate, EPR 1 over 365. You added 1 to it. You raised it to the power of 365 to get what I'm going to call 1 plus, so that's the 1, plus this. And this is called the effective annual rate. So what you found, very good, very good. Okay, so people who are still practicing or trying that problem, doing the calculation. So let's regroup here. So I'm going to call this the daily effective rate. I'm going to use this symbol, effective periodic rate, EPR 1 over 365. And then here, in general, this is what you did. In general, you converted the daily rate into an annual rate. So you showed me the equivalent amount over a year, which is very important. Over the year, it's 20%. That's really what that is. So I'm rounding it, but let me not round it. Let's put 2 decimals on it, or a few decimals. It's 20.196%, right? That's what it was. All right, so now let's go back to the beginning. The annual rate is 20.196 something. So this is called the equivalent effective rate. Either you could say the daily rate is 0.05%, or in other words, it's 20% a year effective. That's what you would actually pay out of pocket. So then what is this number up here? Does anybody know? Why did they put this number? This is called the annual periodic rate. This is a different number and a different understanding. So what is that? Note that that one's on the paper, but it's lower than the actual rate that you pay. So What is this number? Where does it come from? I think Luis has the answer because he wrote it earlier. You guys can look at what Luis said. And then you can tell me from the first class, what is that in words? I gave you a name for that. No, no takers? No idea? This annual periodic rate only reflects the simple interest. It only shows you the multiplication, exactly. It only shows you if you were to multiply, not the compound effect, not the interest on interest. So it's just the effective periodic rate, which is this one, times 365. It's not this. Okay, so this is taking the effective daily rate and converting it to the effective annual rate. And here it's just the simple interest. Now, in financial markets, the governing laws, or the regulations around consumer communications or customer service, what they have to show the consumer is, or what they're allowed to show the consumer is a standardized annual periodic rate. But it is very misleading, wouldn't you agree? Because this is smaller than what you actually would pay with this credit card. All right, so they're allowed to do that. And the assumption is that consumers know that all credit cards compound interest daily, and they can compare across credit cards which rate or which credit card they'd like to use or buy, or not buy, but I mean apply for or use for a purchase. So this is sufficient in financial markets or by the financial industry standards. However, the assumption is that everybody knows that daily interest is actually charged, and this is just simple interest. Okay, so in fact, most of the population doesn't know this, or a great majority won't be aware that this number, I mean, I am absolutely assuming that, I don't know for sure, but I would suspect most of you weren't aware that this number is not actually what you pay. So what do we take from here? So what we take from here is that whatever we're given, whatever information we're given about a rate, to make calculations for a mortgage, to determine the payment, we need to know how mortgage outstanding, the outstanding balance is charged interest. In a mortgage, the interest is charged monthly. On credit cards, the interest is charged daily. On other sorts of financial instruments, we consider rates of return for dividends. Dividends are often paid quarterly, so you would need a quarterly rate to do your valuations. I'm telling you examples right now, and I'm going to put up, you'll see in the notes that I've included these different contexts. The other one is for bonds. Bonds usually pay semi-annual coupons, so you need a semi-annual coupon rate. Now, these are this standard 4 that I'm going to talk about, but in principle, you should be able to convert to any period, and I'll give you a chance, an opportunity to practice that, okay? So let me take out the next document. This is the other document that I posted. So I use the notation EPR 1/365 for the daily rate, and I introduce this different notation for the other amount, that is the annual periodic rate. I call this a stated rate. So this rate below is an effective rate. But I refer to this rate as a stated rate. It's what's stated, but we understand it's not effectively paid over the year. It's just a simple interest that can be used to compute the effective daily rate that is actually charged. And then in this document, I go through the different terminology. So let's see. We start here. We'll refer to the annual rate compounded daily. So that's the annual periodic rate for credit cards as the stated daily rate. And I use this notation, and that would be credit card rates that are provided. For mortgages, the annual rate compounded monthly, or the stated monthly rate, would be written this way: R subscript 112. I don't know, is this big enough for you to see it? That's for mortgages in the US. In Canada, the rates are actually stated semi-annually to further complicate things, but all right. So dividends paid to stockholders are usually quarterly. So you'd need an effective quarterly rate to do that, but you might hear about a stated quarterly rate. So you'd have to convert this. Now, how do we convert from stated rates to effective rates? Well, we just did one example, and it's going to be the same for all of these. The last one I'm going to mention here is the annual rate compounded semi-annually, or the stated semi-annual rate for coupon bonds, R12, 1/2. So coupon rates on coupon bonds and yield to maturity on bonds will be stated semi-annual rates. What you actually need to use the formulas that you've been introduced to are the effective rates. And so these are the terms. This is the daily rate compounded daily is the effective daily rate, or EPR 1/365. The monthly rate compounded monthly is the effective monthly rate, or EPR 1/12. So you start noticing the way I say things. When I say daily rate compounded daily, you notice those are the same. Monthly rate compounded monthly. When I hear about a rate like that, I know I'm being told about, or we're talking about, the effective rate. That the frequency of the stated rate is the same as the compounding frequency. These need to match to be effective. The quarterly rate compounded quarterly is the effective quarterly rate. EPR 1/4, and the semi-annual rate compounded semi-annually is the effective semi-annual rate. Number 2. And what is the relationship? In general, this is what we did. Well, this is what we used to relate those two rates on my credit card statement was to find the effective periodic rate, I need to take the stated rate and divide by 365. In our example, it was the 18.4 divided 365 gives us the daily rate. Notice, even though I'm using fractions, the subscript here is an n, because n is the fraction of a year that compounding takes place. Quarter, daily, etc. Okay, so that's one formula that you need to deal with. The other formula is a series of relations between the effective rates and other effective rates. If you want to look at a time period like I did in this example over here, I want to convert my daily rate into an annual rate to better understand and compare it to other annual rates. So I do that by this simple compounding that we learned until now. So the only real new thing that you're learning here about is a conversion of stated rates to effective rates. Okay, any questions for me? So I'm going to put up a series of exercises that you can practice and be more comfortable with making conversions. All right, so there's two things you're going to learn, you're going to be practicing: converting from different stated rates to different effective rates, and converting from effective to effective rates. And I have a number of different documents to share on that. So if you don't have any questions for me, I'm going to let you go. I mean, I could do a problem, but I think it's kind of, I don't know. Do you want me to do a problem before we go? Let me know. You can pull something up, and if people have to go, they can go and come back and watch later. So the goal is that we make these conversions into effective rates and then use the effective rate, or calculate the effective rate we would need for each problem. Remember, valuation problems for any asset, whether it's stocks, bonds, investment projects, or investment opportunities, we need to match the timing of payments. We need to convert all variables to the same frequency as the timing of payments. Payments are monthly, then we need to use the monthly interest rate in our formula. We have to convert all periods to months and all that. Okay, so you guys haven't said anything. So you want me to be done? So we're going to sign off, and I will leave it to you to work with the materials. I expect you to have made some progress, considerable progress this week with the materials I post in Unit 2, and we can talk about your problems there. If you want to be reading, the chapters again are chapters 1, 4, 8, and 9, and I will post an assignment with some practice exercises on the Connect platform, but that won't be due until after the test. So we will have just verifying. So we have 2 more classes before the test, so we have lots of time. I've given you a lot of time. So don't wait for me to review. Work ahead, and we'll see you next week. And you have this video to review if it helps to understand what I just said. So have a good night. Keep in touch.